Welcome back to episode 3 of Smart Money. I'm Alex, and today we get to talk about my favorite topic, stocks. Now, what is a stock? That's a question I get asked quite a bit. A stock is an ownership in a company. That's it. If you own a stock, you own a portion of a company. You have a claim on the company's assets as well as their earnings. Now, back in the day, you've gotten a cool piece of paper called the stock certificate, like you see on the screen right now, that represented your shares in the company. But since most transactions are done electronically these days, you probably won't see those. Now, back to the topic. If you own a stock, you are a part owner, also called a shareholder of the company. Not only do you have a claim on the company's assets and earnings, but you also get a say in how the company is run in the form of a vote of who gets to be on the board of directors. Now, unless you're a large shareholder, you probably won't have to worry about this part. If you don't like the company's management anymore, you can consider selling the stock instead. Now, one advantage to investing in stocks is that you can only lose the money you put in. If the worst happens and the stock goes to zero, assuming that you didn't borrow any of the money to invest, then no one's going to ask you to pay anything else. You just lose your initial investment and that's where it ends. It's a lot less risky than trying to start your own business or invest in real estate where your credit can be on the line. Now, what's really sweet about stocks are dividends. Some public companies, not all, choose to pay dividends to their shareholders. A dividend is a cash distribution from a company to its shareholders. It's one way a company chooses to split up their profits and share it with you. All you have to do is own a particular stock on a certain day, called the ex-dividend date, and you get paid. The more stock you own, the more you get paid. Now, why do companies choose to go public in the first place? Short answer, to raise money. At some point, a company might need a boost of cash in order to grow, at which point they usually have three options. Either borrow it from a bank, issue bonds, or issue stock in an IPO, initial public offering. Now, if the original owners choose the IPO route, they give up part of their ownership in the company, but they don't have any creditors to deal with. They just issue stock with no guarantees. Now you have to understand the risk associated with owning stocks, is there's no guarantee you'll get paid. Bondholders and banks get paid first. That's called absolute priority, since they're the creditors. Shareholders gets whatever's left over, if there is anything. Not a problem if the company is doing well, but a different story for companies that are struggling. Now, I'm not here to scare you. With risk comes reward. Historically, stocks have offered much higher returns than buying bonds or putting your money in a savings account, which is why you should consider stocks one of your main investment vehicles. Thanks for watching. I'll see you in the next episode where we talk about bonds.